When a man first comes into this business, he believes the market will pay him simply for showing up. He looks at a chart the way a gambler looks at a roll of dice, but hoping the next move will make him right. But the market doesn't reward hope. It rewards timing. And nothing tests a trader's timing like a pullback. A pullback is where weak hands get shaken and strong hands get their bearings. You don't make your real money chasing a runaway move. You make it when you know when to step in after the crowd has lost its nerve. Now tell me, have you ever watched a stock you liked run away without you, and then, when it finally dipped, you were too scared to act? I learned early that a healthy trend must breathe. Prices don't move in straight lines. They push forward, then they rest, and then they push again. Those little retreats are not danger signs, they are the market catching its breath. The trick is to know the difference between a pause and a reversal. That difference is what separates a trader from a tip follower. When a stock is in a real uptrend, a pullback will usually be quiet. Volume dries up, the bars get smaller, and the selling feels tired. That's the market telling you the sellers have little to say. But do you listen, or do you panic like the crowd always does? Most traders do the same foolish thing. They buy when prices are high and excitement is louder than reason. Then, when the inevitable pullback comes, they sell right where they should be buying. They turn a normal retracement into a personal disaster. I used to do it myself until I learned that the market's job is to make you uncomfortable. A pullback is designed to test your conviction. If you don't know why you're in a trade, the first red bar will send you running. But if you've studied the trend and the tape, that same red bar looks like an invitation. Ask yourself, do you know the difference? Or are you just reacting to color on a screen? When a stock has been climbing steadily and then eases back toward its old support, that's where the professionals go to work. They don't want to buy at the top of the wave. They want to buy when the wave pulls back before it pushes again. That's how big money builds positions without tipping its hand. The chart will often drift sideways or slightly down, like a tired boxer leaning on the ropes. To the untrained eye, it looks weak. To the trained eye, it looks ready. And you, are you trained to see that, or are you still guessing? Pullbacks also reveal the true character of a stock. A strong stock doesn't fall far. It doesn't collapse in fear. It holds its ground. The bids stay firm, and every dip finds buyers waiting. That tells you institutions are still interested. Weak stocks, on the other hand, fall fast and bounce poorly. They don't attract support. So when you're watching a pullback, you're really watching a test. Will the stock hold up under pressure? And if it does, why would you not be ready to act? Now, let's talk about your own state of mind, because this is where most traders lose the battle. A pullback stirs up doubt. You start to imagine all the ways you could be wrong. You remember the last time a stock kept falling after you bought it. Your hand hovers over the sell button. But the market doesn't care about your memories. It only cares about supply and demand. If demand is still there, the pullback is just noise. Can you stay calm long enough to see that? There is no shame in waiting. Jesse Livermore always waited for the right moment, and that moment often came after a pullback. He didn't chase. He stalked. He watched how prices reacted at key levels. If a stock pulled back to its old breakout area and then refused to go lower, that was his cue. The tape would quiet down, and then, suddenly, it would turn. That was when he acted, not before. Not after? Right then. And tell me, do you have that kind of patience, or do you rush because you're afraid of missing out? Money is made in the waiting, not in the clicking. The pullback gives you a low, risk place to enter because you can define your risk. If the stock breaks below support, you're wrong and you get out. Simple. But if it holds and turns up, you're riding the next leg of the trend. That's not gambling, that's business. Yet most people refuse to wait for that clean setup. They'd rather jump in anywhere and hope. Hope is expensive in this game. Have you noticed how much it has cost you? Your account balance is a mirror of your discipline. Every time you buy a pullback correctly, you're telling yourself you can trust your plan. Every time you chase or panic, you're telling yourself you can't. Wealth in trading is not built on one big trade. It's built on many small, well-timed decisions. Pullbacks give you those decisions if you're willing to look for them. But are you really watching the market, or are you just watching your profit and loss? A good pullback feels boring. There's no drama. The stock just drifts. That boredom is your friend. It means the emotional traders have stepped aside. When price starts to turn up again, volume creeps back in, and the bars get stronger. That's the market saying, "We're ready." If you've done your homework, you don't need to guess. You already know what to do. And when that moment comes, do you act like a professional, or do you hesitate like an amateur? The crowd hates pullbacks because they hate uncertainty. They want constant confirmation that they are right. But the market only confirms things after the move has already happened. By then, the easy money is gone. The pullback is where the opportunity hides. It's not comfortable. It doesn't come with applause. It comes with doubt, and that doubt is the price of admission. Are you willing to pay it? I've seen traders with perfect chart patterns still lose because they couldn't handle the emotional weight of a pullback. They knew, in theory, it was normal. But when their money was on the line, they forgot everything. That's why mindset matters. You must think like a speculator, not a gambler. A speculator expects retracements. He plans for them. He even welcomes them because they give him a better entry. A gambler just hopes the line keeps going his way. Which one are you really? When you learn to trade pullbacks correctly, you stop feeling chased by the market. You start to feel like you're walking alongside it. You let it go ahead, then you join it when it slows. That rhythm keeps you out of trouble. It also keeps you from overtrading, which is one of the fastest ways to give back your profits. The fewer, better trades you take, the more your account can grow. Isn't that what you're here for? When volume goes quiet during a pullback, that silence is often louder than any big spike. Most traders think action is where the money is, so they watch for heavy volume and wide bars, believing that excitement equals opportunity. But in real trading, it's often the opposite. A true pullback inside a strong trend is not noisy. It doesn't come with panic or urgency. It comes with hesitation. Sellers try to push the price lower, but they don't have much strength behind them. The volume dries up because the people who really control the stock aren't selling. They're waiting. And if you know how to read that, you start to see opportunity where others see nothing happening. When a stock is in a healthy uptrend and it begins to pull back, you'll often notice that the candles get smaller, the price range tightens, and the trading activity slows. This is not weakness. This is digestion. The market is absorbing previous buying. The stock is simply letting late buyers and nervous traders get shaken out. Institutions do not rush. They do not dump shares in a hurry if they believe the trend is intact. They step aside, let the market drift, and then come back when the selling pressure runs out. That quietness is a clue. It tells you that supply is limited, and when supply is limited, even a small increase in demand can move the price back up. Think about how a strong stock behaves compared to a weak one. A weak stock falls with force. It breaks levels quickly. Volume expands because people are rushing to get out. That is real selling. But a strong stock pulling back does not act that way. It slips. It drifts. It almost feels lazy. That's because nobody important is in a hurry to sell. The people who bought early are sitting on profits. The big money is still confident. So the volume falls because the urgency is gone. And in trading, the absence of urgency is often a powerful signal. Many traders get fooled because they think low volume means no interest, but it really means no pressure. And pressure is what moves prices down. Without pressure, price can't fall far. When you see a pullback on light volume, you're seeing a lack of conviction from the sellers. They are not motivated. They are not aggressive. They are just there because price is temporarily going against the trend. That's not enough to change the trend. That's just enough to give the market a pause. This is why smart traders wait for pullbacks instead of chasing breakouts. A breakout often comes with heavy volume and excitement. That is where late buyers pile in. But the pullback that follows usually comes with low volume. That's where those late buyers get scared and sell. And that's where stronger hands start positioning themselves. They are not buying in a rush. They are buying patiently. The market feels calm, almost dull. But that calm is deceptive, because beneath it, accumulation is taking place. You can think of it like a crowded room. When everyone is shouting, it's chaotic. But when the noise dies down, you can hear who is really talking. In the market, when volume dries up during a pullback, it allows you to see the true strength of the trend. If price holds steady even with very little trading, that means sellers are weak. And if sellers are weak, buyers don't have to do much to push the price higher again. One of the biggest mistakes traders make is assuming that every dip is dangerous. They see red candles and immediately think something is wrong. But color alone means nothing. What matters is the effort behind the move. If price is falling but volume is shrinking, that means the market is falling without energy. It is being pushed down by gravity, not by force. Gravity can stop easily. Force cannot. So when you see a quiet pullback, you are not looking at a collapse. You are looking at a pause. Smart money understands this. Large traders cannot buy everything at once without pushing the price up against themselves. So they let the stock pull back. They let volume fall. They wait for the selling to run out. Then, when there is very little resistance left, they step in. Their buying then stands out because it comes after a period of silence. That's when volume starts to return, price starts to turn, and the next leg of the trend begins. This is why watching volume is just as important as watching price. Price shows you where the market is. Volume shows you how much conviction is behind that movement. A pullback on heavy volume is a warning. A pullback on light volume is an invitation. It tells you that the trend is probably still alive and just waiting for the next wave of demand. Traders who understand this don't panic during quiet pullbacks. They get ready. When a trend is real, it leaves footprints behind, and one of the clearest footprints is how price behaves when it comes back to where it once broke free. A strong trend does not forget its past. When a stock pushes through resistance and begins a new leg upward, that old resistance becomes something else. It becomes a line of defense. That is where buyers who missed the breakout are waiting. That is where traders who rode the first move are willing to add. That is where institutions quietly decide whether they still believe in the story. And when price pulls back into that zone, the market is asking a simple question: is this move still alive? Most traders don't think this way. They see a breakout level as something that is behind them, something that no longer matters. But in reality, that level becomes more important than ever. It is the battlefield where the trend either proves itself or gives up. If price comes back down and finds support there, it tells you the demand that pushed it higher in the first place is still present. The buyers did not disappear. They just stepped back and waited for a better price. That waiting creates a floor, and floors are what trends stand on. A strong stock will often pull back gently toward its old breakout area. The candles shrink, the volatility drops, and price seems to hover rather than fall. That hovering is not indecision. It is a standoff. Sellers try to press their advantage, but they meet buying interest almost immediately. The market does not allow price to slip far below that old level, because too many participants see it as a fair place to buy. When that happens, you are watching support in action. Weak stocks behave very differently. When they fall back to an old breakout level, they don't slow down. They slice right through it. There is no hesitation, no defense. That tells you the buyers who were once there are gone. They have either lost confidence or moved on to something else. Without them, the stock has nothing to lean on, so it collapses under its own weight. That is why the reaction at old breakout levels is such a powerful filter. It separates real trends from illusions. Traders who understand this don't guess when to buy a pullback. They let the market show them. They wait to see how price behaves when it returns to that critical area. If it holds, if it stabilizes, if it refuses to go lower, that is information. That is the market telling you that demand is still in control. You are no longer buying blindly. You are buying into proven strength. This is also where risk becomes easy to manage. When you buy near an old breakout level, you know exactly where you are wrong. If the stock breaks below that support and stays there, The trend has changed. You get out. Simple. But if it holds and starts to turn back up, you are in a position that offers far more upside than downside. That is the kind of trade that allows you to stay in the game long enough for your account to grow. Emotionally, this is hard because buying near support does not feel exciting. The stock is not racing upward. It is not making headlines. It is quiet, sometimes even dull, but that dullness is where professionals do their work. They do not buy when everyone is celebrating. They buy when the crowd is uncertain. An old breakout level, when defended, creates that uncertainty. Some traders are scared it will fail. Others are waiting for proof. The ones who understand what they are seeing take action while everyone else hesitates. This is not about predicting the future. It is about reading the present. The market is constantly showing you what it values. When price keeps bouncing off the same area, it is telling you that area matters. It is where buyers and sellers have agreed, at least temporarily, that value exists. In a strong trend, that agreement forms around old breakout levels. They become reference points. They become anchors. And as long as price respects them, the trend remains intact. You will often notice that the best trends climb in a series of waves, each one building on the last. A stock breaks out, runs higher, pulls back to the breakout, then runs again. Over time, these levels stack on top of each other like steps. Each step represents a place where buyers stepped in and proved they were willing to support higher prices. That staircase structure is what a healthy uptrend looks like. When one of those steps gives way, that is when trouble begins. Most traders fail to see this structure because they focus too much on short-term noise. They watch every tick, every candle, and every headline. But trends are built on levels, not on minutes. If you zoom out and study how price reacts at key breakout areas, you start to see the logic behind the movement. It stops being random. It becomes a story of buyers and sellers defending and attacking specific prices. This is also where patience pays. You don't need to be in every move. You only need to be in the ones that come back to you. When a stock pulls back to a well-defined breakout level and holds, it is coming back to offer you a second chance. Many traders miss the first move. They watch it run and think they are too late. But the market often gives them another opportunity if the trend is real. That opportunity is the pullback to support. Confidence in trading comes from understanding why something is happening. When you know that strong trends defend their old breakout levels, you stop feeling lost. You know what to watch. You know where the line in the sand is. That clarity makes it easier to sit through small fluctuations and not overact. You are no longer trading on fear. You are trading on structure. The best entries rarely feel good when you take them, and that is something most traders have to learn the hard way. When a trade feels exciting, when everyone is talking about it, when the chart looks obvious, that is usually when risk is the highest. Comfort comes from confirmation, and confirmation only arrives after the move has already happened. By then, price is extended, emotions are high, and the easy part of the trend is often behind you. The market does not reward comfort. It rewards preparation, and preparation often feels uncomfortable because it requires you to act before the crowd feels safe. When a stock pulls back into support or tightens up after a run, it doesn't look impressive. It might even look weak. The candles are small, the volume is low, and price is drifting instead of exploding. There is no sense of urgency. There is no excitement. That is exactly why it works. The market is in a state of balance, and that balance allows you to enter with controlled risk. You are not buying strength that is already stretched. You are buying a pause that is preparing for another move. Most traders wait for things to look perfect. They want to see big green candles, heavy volume, and clear momentum before they feel confident enough to buy. But by the time all of that appears, price has already traveled far from any logical support. Your stop has to be wide. Your risk is high. And if the trade pulls back even a little, you feel immediate pressure. That pressure comes from being poorly positioned, not from the market doing anything wrong. Uncomfortable entries usually happen when price is quiet and uncertain. The stock might be sitting near support, or it might be pulling back in a strong trend. There is no guarantee yet that it will turn. That uncertainty is what creates the opportunity. You are stepping in when others are stepping aside. You are taking a position when the outcome is still undecided. That is what gives you favorable odds. If everyone already knew the price was going higher, it would already be higher. This discomfort also tests your discipline. It forces you to rely on your plan instead of your emotions. You might feel nervous because the chart does not look exciting. You might worry that the trade will fail. But your job as a trader is not to feel confident. It is to follow your rules. If the setup fits, you take it. If it does not, you wait. Comfort is irrelevant. Consistency is what matters. You can see this clearly in how trends develop. A strong trend does not move straight up. It moves in waves. Each wave has a push and a pull. The push is exciting. The pull is uncomfortable. During the pull, traders question the move. They doubt it. They take profits. That selling creates the conditions for the next push. If you only buy during the pushes, you are always late. If you buy during the pulls, you are early, and being early is what allows you to control your risk. This is also why many traders feel like the market is always against them. They buy when things look good and sell when things look bad. They do the opposite of what is required to succeed. The market does not trap them. Their own need for comfort does. When you learn to accept discomfort, you stop chasing and start positioning. You no longer need the market to make you feel safe before you act. The uncomfortable entry is also where your mindset as a trader shows itself. If you believe you must always be right, you will avoid these entries. They feel too risky. They feel too uncertain. But if you understand that trading is a game of probabilities, not certainty, you realize that these moments offer the best reward relative to risk. You do not need to know what will happen. You only need to know where you are wrong. When you buy a pullback or a tight consolidation, your risk is usually close. A break below support or below a recent low tells you the trade is not working. That is clean. That is manageable. When you buy a breakout after a big run, your risk is far away. If the trade fails, it often fails quickly and painfully. So the trade that feels safer emotionally is often the one that is more dangerous financially. Over time, this changes how you see the market. You start to welcome those quiet moments when nothing seems to be happening. You know that they are setting the stage. You become less interested in flashy moves and more interested in structure. You look for areas where price is resting, where volume is low, where sellers are tired. Those are the places where trends continue. The way a stock moves when it is under pressure tells you more about its future than almost anything else on the chart. When price is rising, everything looks good. Hope is high, and everyone feels smart. But when price pulls back, that is when character is revealed. A weak stock cannot handle stress. It falls quickly, breaks levels easily, and invites more selling. A strong stock, on the other hand, absorbs that pressure. It bends without breaking. That difference is what separates trends that continue from trends that fail. When a stock is weak, you can feel it in the way the bars behave. As soon as selling starts, volume jumps. Candles grow large. Support levels do not slow the decline. Every small rally is met with aggressive selling. That kind of behavior tells you that people are eager to get out. They do not trust the stock. They do not believe in its story. So they use any strength as an opportunity to sell. That creates a downward spiral, because selling brings more selling. A strong stock reacts very differently. When it pulls back, it does not do so with panic. The volume usually shrinks. The candles become smaller. Price drifts rather than drops. It is as if the stock is taking a step back to rest, not to retreat. The sellers in this situation are not confident. They are mostly short-term traders taking profits or nervous holders lightening up. They are not institutions abandoning their positions. That is why the decline lacks force. This difference is critical for anyone trying to trade trends. If you buy a stock that falls hard on every dip, you are fighting the market. You might catch a bounce, but you are not aligned with strength. You are hoping for a reversal. When you buy a stock that pulls back softly, you are working with the trend. You are simply waiting for it to resume. You can see this clearly when you compare charts side by side. One stock might drop 5% in a single day on heavy volume. Another might drift down 2% over several days with very little activity. The second one is the stronger of the two, even though it might not feel that way in the moment. Strength is not about how fast something goes up. It is about how well it holds up when it goes down. Traders often get this backwards because fear distorts perception. A slow pullback feels endless. Each small red candle adds to the anxiety, but in reality that slow movement is healthy. It means sellers are weak. A fast drop feels decisive, and that can trick people into thinking the move is just getting started. But fast drops are usually driven by urgency, and urgency often burns itself out quickly. This is why experienced traders study how price behaves at support. When a strong stock reaches an area where buyers have stepped in before, it usually pauses. It might dip slightly below, but it quickly recovers. The bids are there. People are willing to buy. That support acts like a cushion. In a weak stock, support is an illusion. Price cuts through it as if it were not there. That tells you that nobody cares enough to defend that level. Understanding this changes how you approach pullbacks. You stop looking for the deepest drop. You start looking for the gentlest one. You want to see a stock that barely wants to go down. That reluctance is a sign of underlying demand. It means that even at lower prices, buyers are stepping in. That is exactly what you want to see before entering a trade. It also helps you manage risk. If you buy a strong stock that pulls back softly, your stop can be close. The stock does not move far against you before it either turns or proves you wrong. In a weak stock, price can fall a long way very quickly. Your stop has to be wider, and your losses can grow before you have time to react. Strength keeps risk contained. This principle applies to every time frame. Whether you are trading intraday or over weeks, the same logic holds. Watch how price behaves when it is not being helped by momentum. When the wind is not at its back, does it still hold its ground? Or does it collapse? That tells you everything you need to know. It also ties directly into your mindset as a trader. When you focus on strength, you become more selective. You stop trying to make something work. You let the market show you what is already working. That shift saves you from countless bad trades. You are no longer forcing yourself into weak setups just because they look cheap or oversold. You are aligning yourself with stocks that have proven they can handle pressure. Many traders are drawn to weak stocks because they seem to offer more upside. They have fallen far, so they feel like a bargain. But bargains in the market are often just broken goods. A stock that cannot hold a pullback is telling you it is not ready to go higher. You might get a bounce, but you are not buying strength. You are betting on a change in behavior. That is much harder to trade consistently.